Hello and welcome back to The Note. Stocks and bonds have both done excellently in the 5 years since the great financial crisis, but does that mean that they're now too expensive? Is there any more juice to be squeezed out of these markets? With me now to discuss this is the Chief Investment Strategist for the BlackRock Investment Institute here in London, Ewen Cameron Watt. Ewen, thanks for joining me today.
Thank you, John.
Let's start by looking at this fascinating chart that you put together, showing correlation between stocks and bonds. What is the problem here?
The problem here is, as you can see, when the line is below the line, as it were, that means that bonds and equities are moving in different directions. They're offsetting each other. They're diversifying each other. When you're above the line, as you were for much of the 1990s,
Right.
they're not diversifying each other. Most people have a portfolio that's made up of stocks and bonds. If they both move in the same direction, if it's up, nobody cares about
Exactly.
diversification,
Yeah.
but it's like insurance. And when it's down, you want one asset to offset the other, which was the case in 2008 when equities crashed and bonds rose.
Although bonds scarcely rose enough to cancel out the problems for equities. But looking forwards, what are the problems for portfolio structure that you see coming now? We've obviously seen a sharp move in that correlation in the last few months. What does that imply?
I think the problem here is that both bonds and equities in the last 2 to 3 years particularly have been driven by the copious injections of government liquidity.
Right.
And although next year is still going to be very expansionary on the liquidity front, it's going to be less so than this year, and the year after will be even less so. And so if both bonds and equities driven by the same factor, and that factor reverses, is there going to be effective portfolio diversification out there?
Okay, now let's take a look at what valuations look like. Now, these are again numbers that you put together for BlackRock. Take us through this chart. It looks as though bonds are very uglily expensive.
What we're looking at here is where bond yields are in nominal terms relative to their own long-term history. That's for the government bonds at the top. For the high yield and credit at the bottom, it's the spread over government bonds. And looking at this at the end of October 2013, most government bonds had only been more expensive, 15% of their history, and that's a little better than it was a year ago. But you've lost money in government bonds over the last year.
That's how they became cheap. There's still obviously no great case to invest in them.
Correct.
Now let's take a look at stocks. Again, fascinating exercise you conducted with the selection of countries here. So do we see some value still in some stock markets?
Yes, I mean, I think that 2013 was unusual in that with the exception of Japan, most of the return came from valuation expanding rather than profits growing.
Right.
And that's my definition of a bull market.
Yeah.
So we are in a bull market for stocks on that basis. Are we in an overextended bull market? We're looking at this not quite yet.
The US isn't far off, though. I mean, that's a very...
The US isn't far off, but one thing about bull markets or irrational exuberance that we know is it goes on for quite a while. And as I said earlier, there's still going to be a lot of liquidity around next year, but just a slightly slower growth rate than 2013.
So basically your call is that there is still some juice to be squeezed out of the cheaper stock markets.
Yes, I mean, we particularly like Japan because there's strong profits growth and the valuation isn't too extended, as you can see. And we like some of the European markets for similar reasons. I think the US does feel a bit extended, and some of the froth in the credit markets there in terms of some of the high yield issues, some of the terms of the high yield issues are beginning to make me feel a bit nervous about the relationship between stocks and bonds in America.
Okay, one final question. If bonds aren't going to do the job of protecting us against problems in equities, what will? Is this the opportunity for hedge funds, or where else are we going to find it?
Well, this is of course where hedge funds will show whether they really are hedge funds. That is to say, they hedge market exposure. Other areas will be things like some of the sectors of the real estate market, particularly in Asia, infrastructure, debt, real assets in terms of natural resources and things of that nature. But I think that you're going to have to look at taking more illiquidity risk to get your diversification rather than just getting it out of old-fashioned stocks and bonds.
Okay, Ewen, thank you very much indeed. It's a fascinating overview of the problem for asset allocators over the next few years. If you want to read more, Ewen has also written this up as an insight column that you can read on ft.com.